What's the fair market value of your life insurance policy? Welcome to Tea at Taxevity, where you get insights from insiders, our many clients and friends. I'm Pramod Sharma, your actuary at Taxevity. I help people who care about sustainable financial independence harness the power of life and health insurance. Our guest today is Gordon Lang. Gordon, what do you do when you're not being interviewed?
Actuarial work, business promotion, and new product development.
That's a lot to keep you busy.
Fairly busy. We tend to be at the sharp end of the actuarial business. We don't follow other firms, we lead.
Which is why you're here rather than them.
That's correct.
Why would I want to know the fair market value of my life insurance policy?
For two reasons. Let's assume that you have a corporation, closely held corporation, or a professional corporation. You're then in a position, if you have a life insurance policy that's personally owned, to have that policy transferred to your corporation. Now, two things tend to stem out of that. First of all, the corporation starts to pay the premiums. And it is taxed at a lower rate than you would be taxed if you were paid T4 income.
Right, because we buy the premiums with after-tax dollars, and corporate
correct.
dollars have lower tax than personal dollars.
Precisely. And the other one is that in the majority of cases, your policy would have a fair market value, irrespective of whether it has a cash surrender value or not. And you would receive that fair market value in the majority of cases on a tax-free basis.
So that has the effect of taking money from your corporation and putting it in your hands personally.
That's correct. And in fact, the policy is put on the books of your company at not the fair market value, but the cash surrender value. So the net impact is to withdraw sums of money, generally on a tax-free basis, from your corporation to yourself.
What's the process of getting a fair market value assessment?
There are essentially two steps. The first step is to complete a form, get us a copy of the policy, get us a copy of the last policy statement, and also state whether or not you consider that you're in normal health or in substandard health.
Okay, and then based on that, you're able to provide an estimate, which is a range, and then what happens next?
Well, basically, if you're in good health, we don't have you underwritten.
Okay.
But if you're substandard, or if the policy was issued at a substandard rate, we would obtain from your doctor your details of your medical history, have that transferred over to our life underwriter, who would then provide us with an appropriate rating.
Okay.
We would then use that rating to calculate or to set up a special mortality table from which we would derive the fair market value of your life insurance policy.
Okay. And so you've done the fair market value assessment. I'm happy with the results. What happens next?
Then we have additional material for you to complete. This material is on our website. We would bill you at that point in time. The invoice would be higher if there was underwriting than if there's not. And you would pay the cost of the evaluation along with the completed form, and we would then ship out the signed fair market value report, signed by myself as a fellow of the Canadian Institute of Actuaries.
Okay. Generally speaking, are you able to provide an estimate which is free?
Yes, unless the underwriting is required.
Okay, because there you are paying for an underwriter to look at the work and also calculating special mortality tables.
That's correct, and we often have to pay the attending physician as well as have to prepare special mortality tables.
Is there only one way to calculate a fair market value?
No, there are essentially two ways.
Okay.
The first is to compare the premium rates currently on the market compared with the premium rate in the policy. Difference the two and take the present value of the difference between the two sets of premiums.
Okay.
That establishes a fair market value. The other approach is to take the expected future payment on death less the expected future premiums until that point in time. And the difference again between the two is a fair market value.
Then how do you decide which of the two to use?
In the case of a participating policy, we have no option but to use the latter. For all other policies, be they term, whole life non-par, etc., we would value based on both methods.
Okay. If I went to a different firm, would I get the same fair market value?
It's highly unlikely because the assumptions used by different actuarial firms differ somewhat.
Okay, the assumptions are not mandated to be the same for
No,
everyone?
they're not.
Okay.
Our ones tend to be on the conservative side to protect the client against an audit by Revenue Canada.
Mm-hmm. And that's an area that I've personally had concerns with, because I know that sometimes you can get a higher fair market value assessment from some places, and that looks like it's good because then you can get more money out of your corporation, but then it also seems that you're raising a red flag.
Yes, and from time to time, Revenue Canada do in fact audit or ask for an audit of these policies. Now, the audit isn't performed by Revenue Canada. It's performed by the Office of the Superintendent of Financial Institutions, or OSFI, up in Ottawa.
Mm-hmm. Okay.
And we've had a small number of clients audited. We handle the audit function. We respond to the actuary at OSFI and deal with it on behalf of the client.
Yeah, and from what I understand, you've got a relatively large team and you're in 2 cities?
That's correct. Our main base is Calgary, but we have a sales office in Toronto, and our people travel all over the country.
What factors would affect the fair market value of a life insurance policy?
The first would be age, the second would be sex, the third would be state of health, and the fourth would be the type of insurance policy and the period it's been in force.
Okay, if I have a term life insurance policy, there's no cash surrender value, could that have a fair market value?
In many cases, yes.
Okay, and how is that possible?
If it's a term to 100, i.e. the premiums are flat all the way from entry age to age 100, there will always be a value.
Okay.
If it's a shorter term period, like yearly renewable term, 5 or 10 year renewable and convertible term, there may be a small value. We value the conversion option as well as value the term policy itself or term coverage itself.
Could there be a situation with permanent insurance where the fair market value is less than the cash surrender value of the policy?
Yes, there can, particularly with older policies where the individual's still in good health. And the other problem about these policies is the fact that the cash surrender value can be greatly in excess of the adjusted cost base.
Okay, and what happens in that situation?
The difference is taxable at full tax rates.
Mm-hmm. So that would be a policy you probably would not want to transfer to a corporation then?
It really depends on how much the value of the policy is compared with the taxable portion.
Okay. It sounds like there are a lot of different considerations that go into getting a fair market value assessment and then also figuring out whether that policy should be transferred into the corporation.
That's correct. We are by far the largest firm in Canada involved in this area, and as such, we're in a position to give advice on each case and not just provide figures.
Mm-hmm. And how long has your company been in business?
20 years.
Okay, it's quite established then.
That's right, and I have a 55 years of experience in both life insurance and pension consulting.
See, I find that hard to believe. You were saying that you started working in the 1950s?
1959. I left school at 16 and started in the actuarial business at 17.
Yeah, so you've set a record by being the guest who started working earliest, and also you're the guest who's come from farthest away because you've come from Calgary.
And before that, to cross the Atlantic Ocean from Edinburgh in Scotland.
Okay. What's your main message for the people watching today?
Have your policy investigated to see whether it's advantageous to transfer it to your company. Even if the policy has no fair market value or cash surrender value, it still may be worthwhile transferring because your corporation just pays the low rate of tax before paying the premium, whereas you have to pay the premiums out of after-tax dollars.
Okay. And what's the best way to reach you?
To access us on our website, which is www.gblinc.ca.
Thanks very much for dropping by.
My pleasure.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?